Hello class, as we now start on part two of the lecture, just where we left off. If you remember, we had our $50,000 purchase price today, and then in year one all the way through year six we had $1,000 maintenance cost, and then we have $11,000 in labor savings year one through seven as well, and then at the end in year seven we have that salvage value of 15,000. So we see that our total cash in and out, if it's 50,000 at the very beginning, then we have 10,000 every year from year one to six, and then in year seven, because of that $5,000 salvage value, we also have $15,000 instead of 10. We multiply that by our present value factor. You can get it by going through the long way, or you can look at the table. Remember, this would be 10% 1 year, 10% 2 year, 3 year, and so on and so forth down the line. And then we get how much our present value is worth down there, and $50,000 versus all these combined, we come out with a net of 1,250, right? And what does that actually mean to us, that we come out with a net of 1,250? Well, it means that we're going to go ahead and accept the proposal. So it says, how do we decide whether to make the investment or not? If the net present value is greater than or equal to zero, accept the investment. Otherwise, reject it, because basically what it's saying is that it satisfied how much money we would like in return. And so since it's 1,250, we're definitely going to accept it. Since the net present value for the copy machine investment is 1,250, which is greater than zero, we accept the investment. A positive net present value indicates the expected rate of return on the investment is greater than the company's required rate of return. So things are okie dokie, a-okay, approve the deal. And this is just if you're a verbal learner, right? Calculate the net present value of the investment. Is the net present value greater than or equal to zero? If it's yes, accept the investment. If it's no, reject it. So, what is an annuity, right? So the second table that we're going to look at in the back of your book. How does classifying a cash flow as an annuity help with the net present value calculation? Well, annuity cash flows are identical and occur at regular intervals. Annuity tables can be used to calculate the present value of an annuity of cash flow. And using the annuity tables can save time, right? Instead of you calculating it out. So just so it makes sense, all of those maintenance fees, you can use an annuity table for that, because that's over the course of the year. All of those savings, so over the course of the year, you can use an annuity table for that as well. So here's an analysis of the same decision facing Jackson quality copies. We're going to get the same answer using alternative net present value format with the annuities. So we take the $50,000. No need to use an annuity table for that. That's times 1.0 or 1,000%. So you have your negative 50,000. But we have our annual maintenance cost, which is $1,000, right? So we just take that and we find in our annuity table 10%. Right? And we say, okay, how long it's going to be. It's going to be up to 1 to 7 years. So then we go ahead and we find our number. So I want you to pause the video and go back and go check out on the annuity table and say 10%, and then start coming vertically down the line, and then you'll see where you see that 4.8684 for the 7 years, right? So you multiply those two, you get negative 4,868. Right? And then and why is it negative? Because maintenance costs us money going out the door, right? And then the annual labor savings is 11,000, and you multiply that by the same amount because it's still 7 years, right? So multiply by that and you get 53,552. The salvage value is not something that you use the annuity table for, but you can use the prior table to get that. And so you go ahead and use that table to get the 0.5132. You come out with 2,566. So what's your net present value? 1,250. It's the same as what we came up with last time. Just probably got the answer just a little bit quicker. So evaluate investments using the internal rate of return, right? Different type of approach. So what is the internal rate of return method? Internal rate of return is another method used to evaluate long-term investments. As I said in this chapter, we're only speaking of long-term investments. Internal rate of return also considers the time value of money. Internal rate of return is the rate required to get a net present value of zero for a series of cash flows related to a long-term investment. Internal rate of return represents the time-adjusted rate of return for an investment being considered. And if the internal rate of return is greater than the company's required rate of return, accept the investment. If not, reject it. Right? So if it's higher than what your required rate of return is, then hey, thumbs up, let's go. If it's not, then you reject it. So how do we calculate the internal rate of return? So most managers use a spreadsheet called such as Excel to calculate the internal rate of return for an investment. We can also use trial and error to approximate the internal rate of return. The goal is to find the rate that generates a net present value of zero, or closest to zero is more like it in reality. Managers will often rank investments based on the internal rate of return. So how do we find internal rate of return for Jackson's quality copying? Based on the following analysis, the internal rate of return is between 10% and 11%, which is above the company's required rate of return. Thus, we will go ahead and accept the investment. So if you remember what we did, and you look at these numbers here, you see the 50,000 and everything. And your factor at 10% is there, and here's your present value at 1,250. So you want to get as close as you can to zero. So you check out 12%, you check out 11%. But let's say we arch over and we say, okay, let's go to 12% to see if that's where we need to be. We go to 12% and it's a negative 2,100. So we say, oh no, that's a little bit too far. We don't want to be at 12%. 10% looks much better. It looks closer to zero. But then we try in the middle, right? It's like three bears and their porridge. And we see that 11% right here in the middle, that negative 469. Now, although it is a negative number, it is closer to zero than any of these two numbers, right? So we would say, okay, 11% is what we go with. So you see here it says because it's not annuity, use figure 8.9 in the appendix, right? Just making sure that you know that the ones that are for annuity are for like maintenance costs. That you see right there that years 1 through 7, that those are there. Labor savings also 1 through 7. So you see when it's multiple years, then those are the ones that you're going to use the annuity table on. So we just have to remember that we want to get as close to zero as possible, and negative 469 is closer to zero than 1,250, and it's definitely closer to zero than 2,100. All right, so we want to understand the impact of cash flows. Qualitative factors, we mostly speak about quantitative because we're speaking about numbers, and ethical issues on long-term investment decisions. Very interesting topics, things that you really need to know as a manager, especially when you make a lot of decisions. So which basis of accounting is used to calculate net present value and internal rate of return for long-term investments, cash or accrual? Cash basis of accounting is used to calculate net present value and internal rate of return. Non-cash items such as depreciation and amortization are not included in the analysis, although any effect of income tax flow from these items is included, and which is actually discussed later in some other slides. So is inflation included in cash flow projections when calculating net present value and internal rate of return? Yes. Most managers make cash flow projections that include adjustment for inflation. Important point is that cash flow projections must include adjustments for inflation to match the required rate of return, which already factors in inflation. The assumption in this chapter is that all cash flow and required rates of return are adjusted for inflation, as they should be. Prices will continue to rise, and we must make adjustments for our future projections. There we go. What are qualitative factors and why should they be considered when making long-term investment decisions? Qualitative factors are non-financial factors, and that's the key word, non-financial factors management should consider in addition to net present value and internal rate of return data. Examples of qualitative factors are investing in technology that is strategically important. Maybe we had to purchase a company just because we needed their technology, took a loss on the company, but in the long run, it'll be a profit. Maintaining a reputation as the industry leader in innovation. Considering social benefits of investing in long-term assets such as pollution devices, right, may not bring you immediate financial impact to the company, but you won't see as many, people from different environmental agencies knocking down your door. Providing new product lines to draw customers to other more profitable product lines. Very smart. We'll sell this. Sell this little moped. If you come in and buy it, then you look at a car, and if you get one out of 100 people to buy that car, then it definitely pays for itself. Not that the car dealerships are selling mopeds. Managers must consider both quantitative and qualitative factors when making long-term investment decisions. So you as a manager must look at both sides of the coin. When might managers make long-term investment decisions that are not in the best interest of the company? Great question. Because of the significant work involved, managers may develop a vested interest in getting proposals approved regardless of the net present value and internal rate of return results. Managers may be evaluated on short-term results even though it's not in the company's best interest to invest in products uh, that are profitable, to only invest in products that are profitable in the long run. So let me explain. So I'm a manager and I get evaluated on certain things for the course of a year. If I make this short-term decision that I know is going to be bad for the company 3 years later, I'm going to make that not well. I'm not going to, but some managers would make that decision because it affects their bonus. So they get their bonus, and then later on down the line, it's bad for the company. So companies, as you read through the textbook, it'll tell you different ways that companies can kind of combat that. But you have to look long term for the health and the vision of the company, not short term. So how might these ethical conflicts be prevented? Conduct a post-audit which compares the original capital budget with the actual results. So go back and look at those results. So some people may say, oh, why cry over spilled milk? But you do have to go back because you have to evaluate your managers and the decisions that they are making. You want to reward managers who prepare accurate capital budgets, right? You want to reward your people who do well, and design compensation packages that encourage managers to consider long-term profitability. Maybe we give you stock in the company, and then if you get that and you're tied and associated with the fact that the company needs to do well and you have some skin in the game, then you may choose differently in the way that you determine what type of projects you choose and which ones you don't choose. And you provide part ownership in the company using stock options, just like I said. So evaluate investments using the payback method, right? So some of these don't consider the time value of money, but some of them are maybe more popular just because it's a lot easier to do from the company standpoint. So what is the payback method? It evaluates how long it will take to pay back or recover the initial investment from a long-term investment. The time that it takes to generate enough cash receipts from an investment to cover the cash outflows for the investment, typically stated in years. It takes 6 years in order for us to make our money back. Ignores the time value of money, and that's what I was alluding to. It ignores the time value of money, which makes it tough. And ignores the cash flows after the payback period, right? So what if I have this project and we're looking apples to apples and it says, hey, 3 years my project sucks, your project is great, but then after that my project brings in $50,000. People aren't looking at that. So how do we calculate the payback period for Jackson's quality copies? Start with the cash flow data from the copier company would like to purchase. So remember this chart. So today $50,000 is what we spent, right? And we see obviously this is a lot more simple than net present value and internal rate of return, but $10,000. So if we're at negative 50,000, then we come here, we're at negative 40, negative 30, negative 20, negative 10. At year 5, we're at 0. We're square at year 5, and then we're going to make another $25,000 after that. So it takes us 5 years to make our money back, and then after that, we'll get an increase of 15,000 additional dollars going to either this project or to a different project. So if you want to look at it a little differently, or actually just how I just said it, right? You have your 50,000, your square there, then it goes to 40, 30, 20, 10, and then that's the uncovered investment balance, and now you're at 0. Right there, and you're good to go. All right, so it will take 5 years as shown in the table. So you want to evaluate investments with multiple investment and working capital cash flows. So how do we evaluate investments with multiple investment and working cash flows? Investment proposals often include investment cash outflows at varying points throughout the life of the project. For example, expansion of facilities in a future year, working capital investments to fund an increase in inventory in future year. So didn't make it to only two videos this time either, so stay tuned and then log back in for part 3 of the lecture for chapter 8, but it will be really short.